Golden Apple revenue crushes estimates and the iPhone sales surge, but the tech giant finally feels the chip shortage. And Standard Chartered's profit rises on gains in wealth and markets. It sticks to a forecast of flat earnings growth for the year. Good morning, everybody. Let's get to the futures picture then. Just a few seconds to go until the start of the European equity trading session. And futures do point to the upside, increasingly so, actually. And we have US equity market futures pointing higher as well. No surprise that the tech theme plays heavily in the United States, with NASDAQ futures up by 8 or 0.9%. Here in Europe, we've got plenty of earnings to deal with as well. So European equity markets opening and expected to open higher. The Stock 600 out of the gates with a gain of around 0.1%. The FTSE 100 up by around 0.4%. The IBEX in Spain up by 0.3%. A number of positives, I suppose, driving markets right now, whether it's the Fed that's being patient or the fiscal spending drive, given a lot of profile stateside, of course, by President Biden, and the impact of all of that. We'll get to that, the economic conversation around that in just a moment. But that seems to be what is driving markets, plus the fact that, yes, we do see a slightly higher 10-year yield, but not a surge in yields that is spooking markets just yet. 1.63% is where we trade on the US 10-year. Japanese markets were closed, of course, so it took a while to get those prices overnight. So that's where we open. We open to the upside. Really, it's talk of what the Fed is doing and also the fiscal side of things in the United States that seems to be pushing equity markets, pushing risk assets to the upside. The dollar is fairly flat this morning. So the Fed has upgraded its assessment of the US economy while keeping policy and asset purchases steady. While signaling risks have diminished, Chair Jerome Powell said it's not time yet to talk about tapering. He also countered criticism that the Fed is running risks with inflation.
For many years, we've been focused on inflation deviating below 2%, and we used our tools aggressively to keep it back up at 2%. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that. This is not what we expect.
Joining us now is Janet Henry, HSBC Bank Global Chief Economist. Janet, good to speak to you. So thinking about where the Fed is at this point, we heard there from Jerome Powell talking about inflation, and we all know that the Fed is happy to see inflation overshoot for a period, but he was there talking about inflation expectations. Is that a bit of an unknown then, whether if inflation expectations shoot higher, might the Fed have to act outside the sort of timescales they've been talking about up to now?
They might, but actually, in the press conference, I suppose virtually everyone asked some version of the same question regarding tapering and this need for further substantial progress. And actually, one person did ask, well, what happens if inflation and inflation expectations pick up too much before you've seen the required degree of substantial further progress regarding labour markets? And he made the point very clearly that it's very unlikely that you would see, I suppose, after this initial hump in inflation driven by energy and maybe something to do with bottlenecks, he would be very surprised if you were to see a sustained, sharply higher move in inflation expectations without having seen a big improvement coming through in the labour market. But he left everyone in no doubt that that the Fed, as you showed in your clip there, that should they be proved wrong, should we get this rise in inflation expectations, then they would act. But he was very clear that all elements will most likely move together.
And that's interesting in the context of the fiscal narrative in the US then, Janet, because we've heard a lot overnight about what President Joe Biden plans to do fiscally. We already knew a lot of the numbers, of course, around infrastructure and relief, immediate relief for the US economy. You've been doing a great deal of work on just how inflationary that fiscal package will be in the US. What were your conclusions?
I think that the numbers that we've got initially, the 1.9 trillion package, remember a lot of that's direct payments and a huge amount of that is happening in 2021. These are very big numbers, and we'll get confirmation today of at least what happened in March, because we'll get the first quarter GDP figures. We know a lot of it will be spent in the second quarter as well, and we'll have the reopening. But a lot of what we heard about yesterday was confirmation of what's been dribbling out in recent days and weeks. And we need to remember a lot of this, while they hope to push it through in however many reconciliation bills and such like comes through, it's much longer term and it's much smaller scale. It's not 8% of GDP in 1 year. It's actually do the spending over 8 years, do the tax raising over 15 years, and a lot of it will be funded more towards tax increases. So our conclusion is that, yes, we're going to see this rise in inflation. It will peak, it will come back down, but actually a lot of it's still about labour markets for 2022, which is why our forecasts for 2022 are actually pretty similar for the Fed. It is that labour market story. And obviously Powell talked about the wage story himself quite a lot yesterday as well.
Yeah, that does seem to be getting through then, because you're the second guest on this program this morning, Janet, who's flagged to me not to focus too much on inflation and to think about the labour market story. That is focus for the Fed, of course. What does the political backdrop mean for an economist at this point, Janet, when you look at the US story? I was reading a piece by a colleague today, taking a sort of long view at the political shift we're seeing in the United States right now, saying that under Reagan and Volcker, we saw power shifting from Labour to capital, and now we're seeing something that looks like the reverse of that under Biden and under Powell, asserting the role, essentially, of government and higher taxation. What does that mean from an economist's perspective?
Well, I think Powell was very clear yesterday that fiscal policy is for democratically elected politicians. Central banks have to take that fiscal backdrop as a given and be prepared to adjust policy as required in order to meet their inflation outlook. So what's happening on the fiscal front by this change in approach obviously adds yet another element of uncertainty to what might happen over the course of the next couple of years. But so too does corporate behaviour. And this is something that Powell touched on to some degree as well, making the point that there are still 8.5 million people that are not in the labour force that were. And even in leisure and hospitality, about 3 million, and whether some of those jobs just won't come back. Because obviously we'll see certain areas of automation. We will see companies respond in certain areas if they can't get workers or if they're not prepared to pay the higher wages, particularly if we see minimum wage rises and such like. A lot of it will depend on what happens to the corporate side. So like a lot of things at the moment, it's another element of the great policy experiment that is underway. But all things are moving together. They're not just sitting back and companies are not responding and the Fed is just not responding because of what's happening on the fiscal side. They will adjust depending on how these factors play out.
Janet, thanks very much. Stay with us. Janet Henry, HSBC Bank Global Chief Economist. Thanks for your thoughts so far, and do stay with us here on the programme. A little bit of breaking news coming through from BT. BT saying it is in talks, confirming it is in talks in relation to BT Sport. It has held talks with a number of select strategic partners. Talks are being held. This confirmation coming then through this morning. We had been reporting, other media outlets also reporting, and we had been reporting overnight that these talks were taking place. They're confidential and may or may not lead to any outcome. And I mentioned this given that broadcasting rights for sport have been such a hot topic of conversation in recent months. Coming up here on the programme, we take a look at some of the movers this morning, including Shell. The oil major reduced its debt burden as profits surged. We'll get the market perspective next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America.
There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Welcome back to the European Market Open. We're 10 minutes into our European trading session, and these are the moves we see in the overall markets to the upside. US futures also point higher. Here in Europe, though, plenty of earnings to get our teeth into, and Bloomberg's Danny Berger has been doing just that. She joins us now with the movers. Danny.
And a lot of oil majors reporting today. Good results as well, beating expectations. So Equinor, Total, all rallying. I wanted to point out Shell because they've delivered on a key part that shareholders were looking for, and that's increased payouts, which of course they slashed amid the pandemic. So their payout is 4% higher. They've also used the extra cash they have on hand to pay down some debt. So those shares rallying about 1.5%. Unilever, another one to gain today. So their results also better. We had just heard from the CEO, thanks to a lot of the high-end personal care, beauty type products. But again, part of the reason shares are rallying here is because of the return of cash to shareholders, but this time in the form of buybacks. They've announced a €3 billion buyback program. Airbus, another stock to do very well today. Bernstein analysts point out that they beat on all key metrics. This is, of course, significant given that the air industry has been struggling, though Airbus executives pointing out that it's because of fluctuations in the market. It doesn't necessarily mean this pace is going to continue for the rest of the year. Now, when it comes to the market as a whole, the message is coming from the Fed, and the Fed is staying on message. FOMC really redoing their risk assessment in a way, perhaps less risks out there, pointing out the strength in the labor market. That means that dollar can continue its weaker trend. It's mostly flat now, but some of the more risk-sensitive currencies, such as the pound, is gaining versus the dollar. And I also just want to flag NASDAQ futures, which are up higher, leading the market after that Apple and Facebook blockbuster earnings that had those shares moving higher after hours, Anna.
Yeah, absolutely. Certainly keeping an eye on tech earnings. Danny, thank you very much for that. Also keeping an eye on telecom equipment companies here in Europe, because we've had earnings out from Nokia, and the response to the earnings from Nokia really strong. We see the share price up quite considerably in this morning's trading session. We see some real strength in that share price. Adjusted operating margin 10.9%. That was against an estimate of just 2%. So much more profitable business than had been anticipated. The share price up by 13.7%. We're also seeing some other commentary that's really clearly impressing analysts. The Q1 results significantly above expectations, according to analysts at Odo. They are talking over at Nokia about remaining alert to limited semiconductor availability, but going on to say that the impact of the chip shortages will not be material. Interesting to see they keep their outlook despite that outperformance. We will talk shortly to the CEO of Nokia. Pekka Lundmark is going to be joining us a little bit later on in programming. That's in around half an hour's time, in fact, and we'll talk to him about that. We'll talk about the competitive threats as well, talk about how they are doing against rivals in the sector. Let's get a Bloomberg Business Flash, though, for you now. Here's Laura Wright.
Thanks, Anna. Apple's had a blockbuster quarter with soaring revenue and stronger than expected demand for iPhones, but there was one major snag. The global chip shortage is finally catching up to the tech giant. Executives are warning that supply issues are hitting the sales of iPads and Macs, two products that performed well during the pandemic. Qualcomm is giving a bullish outlook for the current quarter, buoyed by demand for 5G phones. The world's largest smartphone chip maker is seeing a boost in countries like China as part of the world's return to normality. The firm is also seeing demand from outside the mobile phone market for connected devices and home electronics. China is reportedly planning to slap a fine on Tencent as part of its antitrust crackdown. Reuters is reporting the tech giant could face a penalty of at least $1.6 billion. That's less than the amount levied on fellow titan Alibaba. The company reportedly faces the fine for not properly reporting past acquisitions and investments, as well as some anti-competitive practices. That's the Bloomberg Business Flash. Anna.
Laura, thanks very much. Laura Wright with some of the corporate stories we're covering this morning. Sticking with that theme, European corporate results are in full swing, and it is a big week for European banks. Investor optimism in the sector's recovery seems to be paying off with a spate of strong results. The Stoxx 600 Banks Index is picking up pace after stalling last month. Let's think about the economics that's driving this better picture. Janet Henry, HSBC Global Chief Economist, is still with us, and clearly one of the things that would please bank investors, Janet, would be to see steeper yield curves. That's often cited as many as, well, flat curves, making it difficult to make money in the banking world. In terms of the macro inputs then for banks to deal with, what are you expecting to see in yield curves, Janet? Do you still see them steepening? I suppose we can think here about Europe specifically. Europe being behind the United States in its recovery. Do we still have some steepening to go in that curve?
Well, I'm not the fixed income strategist, but obviously we've had the ECB really pushing back against any tightening in financial conditions, although their last press conference, I suppose, added a little bit of ambiguity to that statement. But what we probably are going to see, obviously, is that Europe is at a different stage because of the more recent lockdowns. The recovery, the bounce back in growth is going to be coming through a little bit later than what we've seen in the UK and in the US. But we've seen a rebound in consumer confidence. Lately, we've seen a revival coming through in terms of the pace of vaccinations. We're going to see a pace of reopening. And actually, even on the inflation profile, while I don't think anyone is really worried about inflation risks in Europe to the same degree as perhaps they are in the US, the peak in inflation comes a lot later in Europe. It's in the final months of the year that we do expect to see higher inflation. So yes, it is possible, even though we still think that bond yields are driven globally, you do get variations within regions, and it could be that as part of this later recovery and rebounding growth, we do see things come through a little bit later in Europe.
Yeah, as you say, things have spread across the Atlantic, and the ECB has had to push back on that in the past. One of the other things that's come out of this earnings season, Janet, has been talk about supply chains. We see big tech companies talking about this. We see healthcare companies talking about it. Certainly the auto sector talking about supply chain issues, and specifically around semiconductors. Is this something that's showing up from a macro perspective at all? Is it delaying supply, delaying output sufficiently for that?
There's certainly a lot of discussion about it, and as you say, whether it's an auto company, a toy maker, a phone maker, we're all learning quite how many semiconductors and electronics are involved in all of these different sectors. At the macro level, we're seeing it in some areas of producer prices, and we're seeing it in some of the survey data. We're also at the CPI level, obviously seeing that mix of a sharp rebound in goods price inflation. We've seen that in the US. For the last couple of decades, it was always you had goods price deflation. Over the last year, you've had a really sharp rebound in goods price inflation, but service sector inflation has been a lot weaker because we haven't seen the same revival in service sector spending. So I think we are seeing it, and we will probably see further evidence of it. Powell talked yesterday about these ongoing risks regarding bottlenecks. He obviously still sees them as transitory, that we will see some of these bottlenecks be ironed out, but it could take perhaps longer than is feared. Things could be a little bit stickier. And certainly on our profile, we think in 2022, you'll see slower goods price inflation and actually some kind of revival in service sector inflation. So far, some of it's going on margins and disruptions rather than feeding through to the CPI level.
Yeah, that's interesting, Janet, because I was going to ask you about pricing power. That's another theme of the earnings season. A number of companies talking about their ability to set prices, and I wonder if you've seen anything of that in the data, given what you just said there about PPI, factory gate prices, and maybe in the services sector.
On the good side, yes, we have seen some element of it. It has been, but on the, I suppose, as I say, it's part of a broader rebound, goods demand. Say, for instance, in the US, over the course of the last year, it's not just that we're way above pre-pandemic levels, we're above the pre-pandemic trajectory. People haven't been able to consume services, but the bulk of spending as it's come through has been very much in goods. We've even seen that in the retail sales figures that we've seen for March. So there's been strong demand in those sectors where you've also seen the bottlenecks. And yes, you have seen that in the hard data for the CPI. But remember, when you're thinking about consumer spending, in the US, nearly 70% of consumer spending is on services. So even getting some big pickup in goods prices doesn't necessarily have a lasting impact on CPI. It's a relative price adjustment. And as we all know, in the core PCE, for instance, a third of it's rental prices. So it adds to the inflation narrative and the inflation risk. But for broader inflation, there are a lot of different moving parts.
Janet, thanks very much. Thanks for your thoughts this morning. Janet Henry, HSBC Bank Global Chief Economist. Janet will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Coming up, we'll stick with that earnings story, but we'll talk about tech. Apple crushed revenue estimates as demand for devices surged. It also raised its buyback program by $90 billion and boosted dividends. We'll dig into Apple's results next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Welcome back to the European market open. 23 minutes into a positive session for European equity markets. Positive outside of the Xetra DAX at least, up by 0.4% on the stocks Europe 600. Let's talk about tech, because that is certainly pushing up expectations on US futures. NASDAQ futures up 0.8%. And Apple specifically, because that business had a blockbuster quarter with soaring revenue and stronger than expected demand for iPhones. But there was one major snag. The global chip shortage is finally catching up with the tech giant. Executives are warning that supply issues are hitting sales of iPads and Macs, two products that performed well during the pandemic. For more on Apple, let's get to Matthew Bloxham, our Bloomberg intelligence expert on the sector. And Matt, good to speak to you. So what is driving Apple's record March quarter revenue? This was a pandemic winner, I suppose.
Yeah, very much so. And it's been a pandemic winner for the last few quarters. I mean, you know, we saw incredible strength across all of their product lines. But, you know, it's still very much an iPhone-led company. You know, out of the roughly $90 billion of sales in the quarter, $48 billion, so over half, were from the iPhone, up 66%. Year on year, so still incredibly important to the business, and that's really down to the iPhone 12, which was their first 5G phone, which launched in Q4 of last year, but this was the first full quarter of sales, and it was they saw great strength in the higher end of the product range, so the more expensive iPhone 12 Pros and Pro Maxes, which has kind of really helped. There's a volume and pricing effects there.
Okay, so that's two positives. What about the negative, the look ahead, and the possibility maybe that the global chip shortage has an effect?
Yeah, that's right. I mean, they said $3 to $4 billion headwind in the next quarter, you know, which is significant. But to us on the call, they sound fairly relaxed about it. And their newer devices, which have this new M1 chip, got the sense they don't see those being affected. I think, you know, analysts, I think, generally a little bit more cautious that as people come out of lockdowns, that pandemic strength that's helped them, people buying iPads and new computers to work at home, that will start to fade. But I think the company sounded more optimistic about the strength of the product lineup and sustaining that demand, to be honest.
Okay, Matt, thanks very much. Thanks for bringing us the update. Certainly one we'll be watching when US equity markets open up later on today. Matt Bloxham from Bloomberg Intelligence. Coming up on the program, as the humanitarian crisis in India worsens, businesses around the world step in to try to do what they can to help. We speak to the group CEO of the UK India Business Council, talk about bilateral corporate efforts and cooperation to try to do something to help the people of India. That conversation coming up next. This is Bloomberg.
focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European market open, half an hour into our European trading session, and things looking fairly positive at the aggregate level, less so for the Xetra DAX, which is down by 0.2%, the FTSE 100 and the CAC 40 both up by more than 0.5% though, so Stocks Europe 600 is positive. Just looking for the sector moves, and we have personal goods is certainly the biggest gaining sector, and the biggest weight in that sector to the upside is Unilever. So I'm glad we managed to bring you our conversation that Anne-Marie had with Alan Jope a little bit earlier on, but that stock, the return of cash to shareholders and the outperformance of some of their numbers, that stock up by 3.5% as a result of the company's performance. The sector to the downside is autos and parts, and so that goes some way to explain why we see weakness in Germany today. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. President Joe Biden says the US has turned the corner on the coronavirus pandemic that's killed more than 500,000 Americans. At his first address to a joint session of Congress, the president promised tax increases on the wealthy to pay for his $1.8 trillion spending plan. He now sees America turning crisis into opportunity. The UK has ordered an extra 60 million doses of the vaccine produced by Pfizer and BioNTech. It will form a part of the booster program to protect the most vulnerable people against COVID-19 before winter. The aim is to ensure that the most at-risk adults are fully protected amid a potential surge when the weather gets colder. Michael Collins, one of the 3 astronauts on the historic Apollo 11 moon mission, has died aged 90. He became known as the Forgotten Astronaut despite his pivotal role in the mission. He piloted the command module circling the lunar surface as fellow astronauts Neil Armstrong and Buzz Aldrin became the first people to walk on the moon. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you very much. Laura Wright here in London. Let's turn to the humanitarian crisis in India. It's hit another daily record in cases, with more than 370,000 reported in the last 24 hours. And more than 3,000 lives were lost. As authorities and hospitals struggle to cope, businesses are stepping in to help ease the crisis. The lack of medical oxygen has had devastating consequences, and a bulk of the efforts have been directed at boosting supplies. My next guest has been part of coordinating corporate efforts between the UK and India to provide help on the ground. Joining us now is Jayant, Krishna, UK India Business Council CEO, who joins us now from New Delhi. Jayant, good to speak to you. Thanks so much for joining us. What are you able to do to try and help? What is the business community doing to try and help here?
The situation is on the ground is quite grim, that everybody knows. So what we're trying to do, we have reached out to our large network in the UK, extending to thousands of businesses. We've written to them, we have appealed to them through our website, and we are talking to many of them directly to figure out, that what is on a purely humanitarian basis, what's the help that they could render, and we are collating that data, and we are working very closely with the British High Commissioner in Delhi, as well as the Indian High Commissioner in London, to mobilize the business, to canvass the support and put things together, and eventually help the two governments in lining up the logistics also, so that the benefits and the support reach the beneficiaries, in the quickest possible time. So that's the kind of coordination we are doing,
That's the kind of coordination. Those are the supplies that you're trying to get to the people of India. Jayant, does it feel like a drop in the ocean? Does it feel like the business community, the help it's rightly offering, does it feel like it touches the sides?
In a way, yes, because see, UK's Prime Minister has already sent, and India has already received lots of oxygen concentrators and so many other things. But the fact is, the gravity of the situation on the ground is so huge that the more you do, the more seems to remain to be done. So UK is doing. US President has also agreed to intervene and ensure that the supply of raw materials which are required for production of vaccine by the two companies in India, that also is eased out. So I think there are efforts all around, and yes, the crisis on the ground is so huge that there's a long way to go. As far as oxygen goes, I think there has been slight improvement in the last 2 days with a lot of industrial oxygen, which steel plants and many other companies were producing. That is being shipped to major urban centers. It's not that easy because bulk of the oxygen that they manufacture is actually in the gas form, and what gets filled in the cylinder is largely in the liquid form. And even to ship it, you don't need ordinary tankers. You need cryogenic tankers. So all that is there. Lots of governments are helping, there's been some improvement, but still a long way to go because the requirement of oxygen is at an unprecedented level. Some pockets in the country, like Bombay, which is a business capital, has shown some improvement and some dip in the numbers, and therefore the strain on the hospitals is relatively less. But Delhi is to show that improvement.
Is there support either in the wider population, Jayant, or within the business community for any kind of tougher measures, any kind of further lockdowns? I know India had a tough experience with lockdowns in the earlier wave of coronavirus, and I know that we have seen some state-implemented regional restrictions coming in, but is there any sense that that is being called for, that would be necessary at this point? Is that part of the narrative at the moment?
Surely, while we have reached out directly to the businesses in UK, but for example, if you look at the Indian diaspora, we have about 1.5, 1.6 million people forming the Indian diaspora in UK, and many of them are very, very affluent. So I think it's an appeal through your channel to them as well to reach out to help their motherland. Because it's very, very important. We need everything today. We need empty oxygen cylinders in 10 and 45-liter capacity. We need oxygen concentrators. We need remdesivir, and a whole lot of, and even oxygen manufacturing plants are required. So any help at this point of time, this is an unprecedented crisis. Some say this is the biggest crisis since the partition of India happened. And the wave 1 was incidentally handled quite well by government of India. But wave 2, nobody anticipated that the numbers, we are yet to reach the peak, but the numbers are already 4 times the peak of wave 1. So it's a huge challenge, and the government, the industry in India, and in the UK-India economic corridor, we are leveraging that help, and I'm sure in days to come the situation would improve, before the numbers start going down.
How is the political response, the international political response being interpreted here, Jayant? Clearly, help is being sent. You've called out for further assistance there. And some help is being sent by the US. There's a conversation there, and by the UK. But the UK and many other countries saying they don't want people from India to travel to the UK anymore. We've now seen the US calling on its citizens to leave India. How is all of that being interpreted on the ground?
Given the situation in India, US and UK and many other countries who have imposed travel restrictions or issued advisories or made it necessary for people coming back from India to quarantine, I think it's in the fitness of things, and it's a temporary measure. As the situation on the ground improves in India, I'm sure these restrictions will go. And I don't see anything wrong, because these countries, to protect their own people from the virus reaching through Indians, or people of their nationality who have traveled to India and coming back, I think they are perfectly all right in putting these restrictions for travel from India. And I'm sure sometime later in May, as the numbers reduce, these would go away.
Thank you so much. Thanks for joining us, Jayant Krishna, UK-India Business Council CEO, clearly calling there for more support from businesses globally, essentially, for what's happening in India. Coming up here on the programme, we'll get back to our conversation around the markets. It is 8:38 here in London, 9:38 in Paris or Berlin. We'll pivot to a conversation around Fed policy. The Fed upgrades its economic view, but Chair Jerome Powell says it's not time yet for tapering. We'll discuss the impact on markets with the Market Live team's Laura Cooper. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Tonight, I come to talk about crisis and opportunity. Together we passed the American Rescue Plan, one of the most consequential rescue packages in American history. We're going to get rid of the loopholes, allow Americans to make more than $1 million a year and pay a lower tax rate. And the IRS is going to crack down on millionaires and billionaires who cheat on their taxes. Trickle-down economics has never worked. And it's time to grow the economy from the bottom and the middle out. Wall Street didn't build this country. The middle class built the country. And unions built the middle class. There is simply no reason why the blades for wind turbines can't be built in Pittsburgh instead of Beijing. No reason. None.
Some of the highlights there from President Biden's first address to Congress. Joining us now is Laura Cooper, Bloomberg Markets Live macro strategist, and we see some positive response in the main, well, to the Fed and also to what we heard from President Biden then, Laura, in terms of his fiscal stimulus plans. I was saying this to Mark in the last hour. It's interesting how the market seemed to like tax cuts under President Trump and now finds enough to like about fiscal policy and fiscal redistribution policy in what President Biden is talking about. The market just wants to look rosily, I suppose, on a plan.
Well, and that certainly is the case, Anna. I think that markets are just grasping for any kind of narrative that continues to propel stocks higher, continues to keep just this overall broader risk sentiment quite sanguine across markets. And I do think what's driving the Fed this morning, or sort of what's driving markets this morning, is actually the Fed. And that's because the main message was just the fact that keep calm. They're going to continue to ease on. Yes, they see, price pressures as transitory. They're taking a holistic view of the labor market. Millions of Americans remain unemployed. And so, yes, we are seeing just a string of economic data come through the U.S., but that's not reason yet enough for them to shift their policy stance because they don't yet see that substantial progress that's needed.
Keep calm and ease on. I could see it on a coffee cup somewhere near you, Laura. That's for sure. What about the Markets Live question? You've been thinking about tech earnings, no doubt. How long before the Nasdaq reaches 20,000 is the question you've been asking. It seems as if tech earnings are certainly pointing in an upward direction.
Well, and when I read this question this morning, unfortunately, I don't think most market watchers have a crystal ball on timing. That 20,000 mark for the Nasdaq is still quite a ways away given where we are now. And I think the question is, yes, we've had these blowout tech earnings from Apple, from Facebook, and that's largely reflective of this first quarter, partly this work from home environment. And I think the question now is really, given these upbeat earnings, can they really sustain that financial momentum going forward? It's unlikely to be the case because we are seeing economies reopening. We are going to potentially see yields resume their climb higher in the U.S. on the back of that further stimulus. So I do think it's going to be quite a challenging environment for the Nasdaq to continue to gain. And because that's likely reflective of just more of that cyclical rotation, those fundamentals for that shift are still in play.
Laura, thanks very much. Laura Cooper, Bloomberg Markets Live, macro strategist. Thanks for joining us here on the program. We are 45 minutes into what is a positive story for European equity markets in the main, and a lot of positive response to some of the earnings stories, including this one. Nokia shares jumping after a big earnings beat. We speak to the company's CEO, Pekka Lundmark, after the results hit the wires a little earlier on this morning. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European market open. 48 minutes into a European trading session that has weakness for autos and that related sector. So the DAX is fairly flat. But elsewhere, we see moves to the upside for European equity markets up around 0.5%. The FTSE and the CAC, as you can see, doing well. Also doing well, shares in Nokia. Let's turn to the telecoms equipment manufacturer. Nokia shares are soaring after it reported first quarter sales that beat estimates. The new CEO, Pekka Lundmark, has embarked on a restructuring plan that slashes costs and steps up research and development. That's as Nokia seeks to take back market share and catch up with 5G rivals. I'm pleased to say Pekka Lundmark joins us now, the CEO of Nokia. Pekka, very good to speak to you once again. It seems that your numbers were much higher, in particular on some of the margins, much higher than the market had anticipated. What did you manage to deliver on that the market had not seen?
Yeah, it was a great quarter. We are seeing growing demand in 5G when operators are increasing their investments, but also because of the pandemic, we have seen a lot of increase in network demand for fixed connections, optical connections driven by remote work and so on. We had 9% comparable currency top-line growth, which is really good for the first quarter.
You talk about remaining alert to the limited semiconductor availability, but you say that the chip shortage is not material. How are you able to navigate around this and to make sure that this is not a material risk?
You know, it is a real shortage in the market. It's not driven only by our sector, but it's driven by automotive, electric vehicles, data centers, consumer gadgets. Hey, look, it's a fight out there, and you have to be in daily contact with your suppliers. You need to make sure that you are important to them, and I'm really happy our people, our organization did a great job.
You did a great job. I mean, what dictates who gets what, though? Because we've heard from various sectors, from telecom equipment to healthcare to autos, and they all want chips. What's dictating who's getting the chips at this point, Pekka?
Well, ultimately, you go back to supply chain management, you go back to relationship management with the suppliers. When there is a shortage on the market, it is things like how important you are in the big picture, how strong your relationships are, and how you manage expectations.
Let me ask you about the 5G performance that you delivered. The loss of the Verizon 5G contract to Samsung, that was something that many analysts were citing as something to watch as a negative in your earnings. Now, clearly, you've impressed the market, but how has that loss of the Verizon contract impacted on the company?
There was some impact from that in Q1, but the interesting thing is that despite that, we had a great quarter in North American market. And what I would like to highlight is that we continue to work with Verizon in many different segments. And during the quarter, we published 5-year 5G deals with both T-Mobile and AT&T. So I'm pretty optimistic about the North American market in the big picture.
Yeah, and let me ask you about market share, because we speak to Ericsson. Ericsson keeps talking about market share growth. That's happening at the expense of somebody. What are you seeing on market share?
We expect to have 25 to 27% market share this year in 4G and 5G. That's according to our expectations. We are increasing our market share in Europe at the moment. In most other parts of the world, it is more or less stable. But then in the network infrastructure business, which is fixed connections and optical networks, IP routing, we are actually continuously increasing our market share thanks to the technology strengths that we have there.
And how does that apply to China, Pekka? Barclays analysts ahead of this earnings statement suggesting maybe you're losing market share there. Any update on the Chinese business?
We have a pretty strong position in China. We are working with our customers in many different segments. Our 5G market share is low in China, but we definitely have targets to participate in the upcoming tendering rounds that will take place later this year.
It's interesting that just a couple of months ago, we were all here at Bloomberg TV talking a lot about retail investors, the increased role of retail investors. And I mentioned this to you, Pekka, because of course on certain Reddit forums, we were seeing certain stocks being picked as something that retail investors should focus in on. And one of them was yours, and you saw a bump up in the share price. I wonder how much that impacts on a CEO or the management of a business more broadly when you see that kind of thing happen. Is it a nice bit of spotlight or an unwanted distraction?
Of course, it's always good as a CEO if there is interest to your stock, but hey, look, the only thing we can do is to do as good a job as possible. We had Capital Markets Day a few weeks ago where we laid out our 3-year strategy, and this quarter that we now published is a great start to that 3-year journey, and ultimately then a good job that we do hopefully is something that will be appreciated by all our shareholders, both institutional and private shareholders.
Can I just ask you briefly then, Pekka, about pricing pressures? We talked about the chip market, but are you concerned about the prices of imports? Are you confident in your ability to set prices?
Well, of course, ultimately, your own pricing power is dictated by your technology strength, and I'm pretty optimistic about how that is developing at the moment. Then the other side of the equation is, of course, the fact that the semiconductor market is tight, and there are examples of semiconductors where we are seeing prices go up at the moment because of the shortage. So it is always a balance between these two dimensions.
Okay, thanks so much for joining us, Pekka. Really good to speak to you. Pekka Lundmark, the Nokia CEO. Thanks very much for joining us. I just want to get some breaking news across the Bloomberg, and this is from Germany, and it's in the shape of unemployment numbers coming through, and actually worse than anticipated data coming through from Germany. The German April unemployment figure rising by 9,000. The estimate was actually for a drop in this number of 10,000, so that does seem to be an unexpected move. The German joblessness number unexpectedly rising amid strict virus curbs. The government has tightened restrictions for pandemic hotspots. We know that story well. So that is part of the macro narrative, I suppose, around the German economy at this point. Keeping an eye on what's going on the euro in conjunction with that. Perhaps we see a little bit of weakness coming through. The euro down by around 0.1%. The dollar fairly flat this morning, and that has been the case for much of this morning. Getting back to the European equity markets, and we do see some moves to the upside, broadly speaking, not for Germany, incidentally, where the auto sector is still under pressure. And you can see there on your screen, the Xetra DAX is fairly flat. We've seen the autos and related parts sector under pressure this morning. Elsewhere, we see moves to the upside for European stock markets, up by 0.6% on the stock 600, and gains in London and in Paris. US futures pointing higher. We've had some positive news out of Apple overnight, really smashing through those revenue estimates. That being seen as a positive. NASDAQ futures reflecting that positivity, up by 0.8%. As many people ask questions about how sustainable strong performance is in the tech sector as we move in certain parts of the world, and certainly not all, from pandemic to recovery. That is it for the European Market Open. Surveillance Early Edition is up next. They'll take you through all the latest market moves here this Thursday morning from London. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Wall Street didn't build this country. The middle class built the country. And unions built the middle class.
Our nation is starving for more than empty platitudes. We need policies and progress that brings us closer together.
We've got a long ways to go. And also, it's going to be a different economy.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 29th of April. I'm Francine Lacqua here in London, and here's what's coming up on today's program. On the move again, Joe Biden says the U.S. has turned the corner on the pandemic, presenting a unified vision of America in his first speech of Congress. Apple crushes revenue estimates after a 66% surge in iPhone sales. Even as the global chip shortage finally catches up with the company, it also boosted its buyback program by $90 billion. And Airbus gets a cash boost from a flurry of new jet deliveries in the first quarter. The chief executive, Guillaume Faury, joins the program shortly. Now let's get straight to the markets. U.S. equity futures higher alongside European equity futures as investors cheer President Biden's ambitious spending plan, also given buoyant earnings from U.S. tech giants like Apple. Our Danny Berger, a ray of sunshine in the morning, joins us now. Danny, what do you have?
Francine, I feel like there are so many macro stories, but they all are pretty positive for risk assets. Those ones you lined out, and of course, the Fed. Look, the message is the Fed, and the Fed is on message. That is one where, yes, inflation might be creeping higher to some degree. The labor market is strengthening, but they are retaining that dovish message. So what does that mean? It means the dollar can resume its downward trajectory. It is flat today, but when we look at riskier currencies like sterling, they are moving higher against the dollar after essentially a two-day holding pattern waiting for the FOMC. You pointed out that U.S. futures are stronger. We have yields ticking higher, although I should say bonds did get a bid during that FOMC meeting. I do want to point out one thing, though, that happened that did seem to spook markets during the FOMC meeting. So around this time over here, you see this drop. This is when Powell says that there are signs of froth in the market. So this did spook investors just a bit. Stocks ended lower on the day, but of course, they're coming back higher in future markets. So, you know, a spook, but not enough to completely throw markets off. Of course, the other big thing to drive this higher are these two companies here, Apple and Facebook, really stellar earnings, be it confirming the ad picture we had from Google, that ad spending is higher, prices are higher, or from Apple that there is demand for devices. Of course, these companies are so massive, they make up such a big part of the S&P 500 that if they're having a good day, both the NASDAQ and the S&P 500 probably will too, Francine.
Danny, thank you so much. Danny Berger there with some of the big names that actually reported yesterday and will report further today. Now, President Joe Biden made his debut speech to Congress yesterday after almost 100 days in the job. He said the U.S. had turned a corner against the pandemic while urging Americans to get vaccinated.
Today, 90% of Americans now live within 5 miles of a vaccination site. Everyone over the age of 16, everyone is now eligible to get vaccinated right now, right away. Go get vaccinated, America. Go and get the vaccination. They're available.
The focus for business and investors was on his tax proposals. The president confirms that his $1.8 trillion American Families Plan would be funded by an increase in taxes for the wealthiest. Well, joining us now for more is our D.C. morning editor, Kathleen Hunter. Kathleen, first of all, this was a significant speech, but actually, will he manage to get some Republicans to vote for it?
Well, that's the big question. And I think that, so far there's very little indication that there's any degree of Republican support for the types of things that Joe Biden is proposing. He could have gone many, many ways in terms of this American Families Plan, and the decision to finance portions of it with these heavy tax increases on the wealthy certainly will appeal to the progressive left and to even some more moderate Democrats, but definitely doesn't have a whole lot of, or if any, support among Republicans in Congress. And so it's looking like Democrats may have to go the route of reconciliation, which is a process that allows them to pass measures with only Democratic support. If they do that, that creates its own challenges as well, but it doesn't look like it's going to be necessarily a very bipartisan effort in Congress.
So, Kathleen, how will this differ actually from other presidential addresses to Congress?
Well, so it certainly was very different. This wasn't a traditional State of the Union address. It's occurring mid-pandemic. It's occurring after the January 6th insurrection. So there were far fewer members in the chamber, even folks like Mitt Romney, the Republican from Utah, who's a moderate, and Joe Manchin, who's a moderate Democrat from West Virginia. They were relegated to sitting in the upper balconies instead of sitting on the floor. So the speech just logistically looked a lot different from what we've seen in the past. And I think that underscores the fact that it was really directed at the American public. This is a speech, I think, that was meant to bring the public on board in some ways more than Congress.
Thank you so much, our Kathleen Hunter, there, our DC Morning editor. Now, Smart Conversations on Bloomberg Surveillance, the early edition. Later on in the program, we'll be speaking to the chief executive of Norway's biggest bank, DNB. After that, we also speak to Chatham House chairman and former Man U board member, Jim O'Neill. So that'd be a good conversation on the Super League, but also on the economy and the markets. Up next, though, we talk aviation. Guillaume Faury, the chief executive of Airbus, joins this program. If you have any questions for our guests, just go to IB and go IB Plus TV Go. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, Airbus is warning that its outlook hinges on no further disruptions to air travel or the global economy. Well, setbacks in fighting COVID have forced governments to tighten borders, weakening airlines and leasing firms that make up its customer base. The recent virus surge in India has hit one of the world's strongest aviation rebounds. Well, my colleague Guy Johnson is now standing by with the Airbus chief executive. Hi, Guy.
Good morning, Francine. Thank you very much indeed. Airbus's numbers this morning, Q1 numbers, pretty much beating across the board on every single major metric. The key question now, of course, Francine, is how sustainable are these numbers? What does the rest of the year look like? As you say, we're joined now by the Airbus CEO, Guillaume Faury. Guillaume, good morning. Q1 looks really strong. How sustainable is it for the rest of the year? What does the picture look like?
Good morning, Guy. And indeed, we released some good numbers this morning, driven mainly by the good deliveries we had finally in Q1 this year, and also the good support of our defense and space and helicopters businesses. I think we should not take Q1 as an indication of the full year yet. There's still a lot of volatility, of uncertainty. I think we have not passed what we call the tipping point of the pandemic, and therefore we have to remain quite prudent. We see a lot of diversity in situations across the globe on the recovery or sometimes the aggravation of the pandemic. It was rightly mentioned, and India is really in a very difficult place. So it's a good Q1, but it's not yet a full year.
What does Q2 look like currently? What kind of delivery numbers do you think you're going to be looking at?
It's too early to say, and we don't have a very strong start in the month of April. We'll see moving forward what it means. So again, that's the reason why we've been prudent, because even for Q2, it's too early to say what it will look like. And we've been looking a lot at the demand last year. It has a bit stabilized overall with the complexity I was mentioning before. But we start to look even deeper now at the supply chain, as there are many repercussions of the pandemic on the whole supply chain. And that's really an area of focus to make sure we can have a good Q2 and then potentially a good second half of the year. But again, challenging situation across the board.
Guillaume, airlines currently have still a lot of aircraft parked. My question is, what is the lag between a recovery in airline demand, i.e. passengers coming back, and a pickup in demand for new aircraft?
Yeah, that's a very important question. And in fact, there's not a single answer to that question. We have different market segments with very different dynamics. When it comes to the single aisle, which is the bulk of our production, actually it's quite directly connected. And we think that when we will see the tipping point in terms of passenger traffic on the single aisle, this will be a strong signal for the recovery, or the start of the recovery on the airplane deliveries. On the wide bodies, it's a very different situation. There was already overcapacity before the start of the pandemic, beginning of last year, and we think it will take by far more time for our own business to recover. And if I try to give a bit more color, we think that the recovery, the tipping point for long-range travel might be in 2022. We think the recovery for us would be more between 2023 to 2025. So you see that there is a bit of disconnect on the wide body, or a time lag between the tipping point for passenger travel and for airplane deliveries.
In terms of new orders, though, you talk about deliveries. Let's talk about new orders. When do you think airlines are going to be in a position to place new orders for new planes?
We have started to see the first indications in North America and the US that airlines are starting to look at new orders, mainly for single aisle or solely for single aisle. That's the US. We think it will come progressively for the rest of the world. So I would say prudently and modestly in 2021, and probably in a much stronger way in 2022.
Guillaume, the pandemic has significantly changed airline economics and airline business models. Freight has kept many airlines alive during this pandemic. Freight rates have been elevated and demand has been strong. The question is whether or not that is a permanent shift. I've been talking to a number of airline CEOs over the last few days. I'm getting mixed messages, but some certainly are talking about a stronger freight market going forward. Do you see that as well? And how is that going to impact the way you plan for your business?
So on the wide bodies, we are not a major player today in the freight market. Our main competitor is almost exclusive in that segment, and it's an important segment moving forward. So we are looking at that segment very carefully. We don't like the idea that we are not active in that segment, and that's probably an area where we will be more aggressive and where we will invest moving forward. We have two strong platforms in the wide-body business, and we think they might deserve at a point in time a freighter version so we could compete and bring our solutions to our customers also in that segment.
Guillaume, how close are you to making that decision? We hear that you're only 50 orders away, for instance, of pulling the trigger on a 350 stretch. Would be a bit bigger than the larger, the 900 at the moment, that would be a freighter. Can you confirm that? How close are you to making that decision? How many orders do you think you need to make that a viable money-making option?
I can't confirm, and we won't take a given number. We are looking at the market potential over the life of the product. So we're really looking at the life cycle and the whole business case. Till the decision is made, there's no decision. So I have no time frame to share with you, and no numbers, no magic numbers in terms of orders. We're really looking at the market potential and the strength of the product. And we believe, as I said, our platforms, our wide-body platforms, are very strong products for the freight.
What are the customers telling you at the moment about that possibility?
They tell us that they believe our platforms and the 350 in particular that you mentioned before would be a very strong candidate for a good freight version. And they tell us that they really would like to see Airbus being a player in that segment. So that's good news for us.
The other thing that's changed in the airline economic story is business travel. I was talking to one CEO, an American CEO, a large American carrier last week, who told me that it is possible that business travel doesn't come back for 10 years in the way that it was pre-pandemic. Again, how does that change the economics of the way you look to your product lineup?
It changes the perspective for our customers and the way they share between leisure and business and the layout of the cabin and the revenue model. Well, what I hear currently is not exactly consistent with what you just said. It's very difficult to really know what will happen, but the major trend seems to be that it will take 2 or 3 years to recover, but people, or most of the people, tend to believe that business travel will recover and will probably be close to what it was before. And we had a different view last year in 2020. We thought business travel would never recover, would never be what it was before, thanks to the use of all the digital tools and the Zooms and the likes. Well, we tend to believe now, based on what we hear, that there will be a combination of more use of digital tools, but also still a lot of business travel, because many businesses now really see the downside and the problems of not being able to travel and to visit your customers, your partners. When it's about infrastructure, designing products, you need to be on site.
Guillaume, you talk about that digital shift that we're all experiencing at the moment. One of the results of that digital shift is there is currently a global chip shortage. Does that global chip shortage impact you? Are you experiencing any problems both within Airbus or within your supply chain?
At the moment, we don't experience problems because of that chip issues. So it's not a problem for us, or it's not yet a problem for us. We think anyway we will not be impacted with the same magnitude like other industries, like the car industries. We are monitoring the situation very carefully, but on that front for the moment, we feel rather safe.
Guillaume, Airbus is invested in China. Your aircraft currently are fully certified to fly. Not everybody can say that right now. How big an advantage do you think you have in China? What is your plan to take advantage of that situation in China? What do you see demand looking like from China as it comes back? The domestic market's already back, international's beginning to open.
Airbus has a long-term perspective with China. We have established a good partnership with Chinese industries. We've supported our customers, I think, very strongly before the pandemic, in the pandemic, and we continue to enjoy a very strong and very trustful relationship with our customers over there. So we continue to take the long-term view with China. I think that's the way it works with China, and we'll continue to behave in the same way, believing that's the right way for China. And we bring our products. We have industrial activities over there. We are very much happy to hear that China is also looking at the decarbonization as one of their priorities moving forward. So this fits very well with what we're trying to achieve with Airbus in general, and in particular in China.
Solid set of numbers, Guillaume. Thank you very much indeed for your time this morning. We really appreciate it. Guillaume Faury, the CEO of Airbus. Francine, back to you.
Guy, thank you so much. Great interview. Guy Johnson there and Guillaume Faury from Airbus. Now we'll have plenty more, of course, on earnings. We'll also go back to the travel industry. We'll look at Boeing versus Airbus. Smart Conversations continue on Bloomberg Surveillance Early Edition. Later on in the program, we speak to the chief executive of Norway's biggest bank, DNB. After that, we speak to the Chatham House chair and former Man U board member, Jim O'Neill. This is Bloomberg.
particularly, sort of the technology landscape, gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We've had strong underlying sales growth of 5.7%. That means we're growing faster than our markets, and it's thanks to our focus on running our business with operational excellence, some good innovation, our purpose-led brands doing well.
So yes, I think we've had a good start to the year. We, as you say, had a significant increase in profitability, up 18%. The 1.4 billion is one of the biggest quarters profit-wise we've had for several years.
And today we announced a €3 billion share buyback that reflects our strong cash delivery. We're in good shape for the challenges ahead.
As you've seen from the last couple of years, we have done a mixture of both buybacks and dividends. And to the extent that we have got surplus in the business, we will be very prepared to return that.
Results with us, which I should say both beat. I mean, it's been a slew of beats for this, including U.S. companies, big tech beating handily, Apple, Qualcomm, and Facebook. The pandemic themes are still there, still buying more devices, still online, ad sales jumping, ad prices jumping. And I also just wanted to put Twitter here as well because they're rising in sympathy with hopes of better ad spending as well. Francine?
Thank you so much, Danny Berger, there with some of the stocks to watch. Coming up, President Biden unveils the American Families Plan in a primetime speech, saying he'll reward work, not wealth.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
On the move again, Joe Biden says the U.S. has turned the corner on the pandemic, presenting a unified vision of America in his first speech to Congress. Apple crushes revenue estimates after a 66% surge in iPhone sales, even as a global chip shortage finally catches up with the company. It also boosted its buyback program by $90 billion. And the Airbus chief executive actually tells this program that 2022 may be the tipping point for long-range travel. The French plane maker sees a cash boost from a flurry of new jet deliveries. Well, good morning, everyone. Happy Thursday. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 29th of April. Now, we're still in earnings season. Actually, it's been quite a week when you look at a lot of the reporting from big technology companies. U.S. stock indices actually racing ahead. Treasury yields also rising. I think it's a double whammy of the Fed giving some dovish assurance, and we had also some pretty blowout earnings from technology giants, really cementing some of the conviction that we saw about the world's largest economy, the U.S., and the fact that it's resurgent. So that's filtering through to some of the Asian markets and then onto Europe. The FTSE still showing some good gains, 0.6%. And actually the good news, the encouraging news that we got from robust earnings also filtering through some of the tech companies here, telecoms, travel and leisure, energy, the big gainers amongst industry groups in the European trading session. Now, President Joe Biden made his debut speech to Congress yesterday after almost 100 days in the job. He laid out the goals for his $1.8 trillion stimulus plan, as well as how he was going to pay for it.
Tonight, I come to talk about crisis and opportunity. Together, we passed the American Rescue Plan, one of the most consequential rescue packages in American history. We're going to get rid of the loopholes, allow Americans to make more than $1 million a year and pay a lower tax rate. And the IRS is going to crack down on millionaires and billionaires who cheat on their taxes. Trickle-down economics has never worked. And it's time to grow the economy from the bottom and the middle out. Wall Street didn't build this country. The middle class built the country, and unions built the middle class. There is simply no reason why the blades for wind turbines can't be built in Pittsburgh instead of Beijing. No reason. None.
Well, joining us now with more is Bloomberg's chief content officer and editor-at-large, Marty Schenker. Marty, first of all, the visuals were actually quite powerful. I think it's the first time in U.S. history where behind the president there were two women. What do we actually hear from the president? How different is this speech from others we're going to hear from him? Is this a unifying, speaking to the citizens almost directly speech?
Yeah, Francine, the symbolism was striking, and even Joe Biden himself started out his speech noting that this is the first time a president has ever said those words. And since the White House had briefed the press in advance, there was nothing really new in the speech, so it was more about style and tone than it was about substance, and I think it was particularly well received.
Marty, how difficult is it going to be for the Republican Party to vote this down if there's an overwhelming majority of Americans that are behind this plan?
You can't overstate how much the GOP stands by its partisan politics in the face of public polling. Joe Biden is getting really high marks, especially for his handling of the pandemic, but he's probably not going to get a single Republican senator, at least, going along with any of these plans. So he's going to have to go it alone with the Democrats. And that's just the way our partisan politics, the state of those politics is right now.
Marty, very quickly, how difficult then is it going to be for the Democrats to actually push it through as it is? Do they, they can just about do it, given the votes they have, but will they have to water it down?
There may be some compromises on the edges, and as we all know, Joe Manchin of West Virginia has raised some questions about the size of this plan, so he will be a key senator. But at the end of the day, I think the Democrats will hold together and get a significant part of his tax and spending plans through.
Marty, thanks so much. Marty Schenker, there, Bloomberg's editor-at-large and chief content officer. Now, back to the European banking sector. Norway's DNB posted a larger-than-expected rise in net profit for the first quarter. The bank said it's targeting a return on equity of 12% from 2021 to 2023, but the impact of COVID-19 makes that target unlikely to be achieved this year. Well, joining us now is Kirsten Bratten, the DNB chief executive officer. Madam Bratten, thank you so much for joining us. First of all, given all of the talk about flexible working from home, actually going back to the office, what's your policy going to be? Will people have to come back to the office full-time, part-time, or how do you see it going forward?
We have no sound.
I think actually we're just having a couple of difficulty, which often happens. I feel like it's a very 2020 pandemic thing that sometimes we can't actually hear each other. So we'll get back to the chief executive of DNB. Now, coming up, selling in May could once again be a popular trade this year. We speak to Jim O'Neill, Chatham House chair and British economist who coined the term BRICS. We'll talk to him next, but coming up, the chief executive of DNB. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Mercedes-Benz is on a path towards neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now joining us is Kirsten Bratten, the DNB Chief Executive. Kirsten Bratten, I hope you can hear me. We were starting to talk about some of what we heard from DNB, but also in general about what the banking system and actually the banking industry will look like post-pandemic. Will you require for your employees to go back to work full-time in the office?
Now, we certainly look forward to a more flexible work life also after the pandemic. We have said that the office is still a very important place to build competence, to build the organizational culture, but most people will be able to choose where they would like to work from for a couple of days in the week. So right now we are continuing to do training program for our managers in order to train them on digital leadership. We are building equipment into our offices to prepare ourselves for more of a hybrid working environment, which will be a change from almost purely digital as where we are today.
How do you see that actually, playing out with your workforce? Are banks that are not as flexible going to lose out because you believe that employees really want that flexibility? And is it flexibility of time or flexibility of place where you work from?
I think it's both. I think flexibility is a direction that banks, financial industry, and society is moving towards. And I think that is not only wanted, but expected by employees going forward. The ability to work remote and work digitally, I think, is one of the advantages we have seen, and one of the reasons why Norway has fared well from a relative perspective during the pandemic. We are one of the most advanced digital societies, and actually our ability to run businesses, not only in finance, but also in other areas, is due to being advanced digitally. But I think this is acknowledged across. I mean, the trend of digitization is scaling, and we see businesses who haven't had digital business models turning around and adapting. For example, our payments app, Vipps, has had 15,000 new businesses signing up onto their platform in the past 12 months because people see that they need to be both physical and digital. But for those who aren't able to do it, yes, I believe that there's a risk of them losing out.
Talk to me a little bit about, if you look at Nordic banks in general, impairments have actually been lower than expected. What happens post-pandemic?
Well, certainly we see that 1 year into the pandemic, Norway has fared well, both dealing with the virus as well as dealing with the economy. So the downturn in the economy has been much less than most people feared entering into this situation in the month of March. We've seen crafty authorities employing support measures. Of course, it's tough for certain businesses, but overall, we continue to see a very robust portfolio, both across our SME sector and large corporates. One of the sectors that we highlight as the most challenging in our portfolio is offshore, but that is now down to 1.3% of our portfolio. And this quarter, impairments came in as a net positive to our results, driven by certain reversals. And we continue to see a robust portfolio across our business activity.
We've also heard more and more from regulators talking about a green asset ratio, and that would basically be a way of looking at some of the climate change challenges going forward. Are you expecting to report such a ratio in 2022 already?
We are certainly working to improve and build the transparency into sustainability. I think the financial industry has a tremendously important role to build in order to establish a baseline on where we are and in order to measure progress. We have worked very actively on sustainability and climate for many years and have this integrated into our credit processes. So we are preparing to report on all of our asset mix in 2022. We have clearly stated our support to a net zero emission target in 2050 from all our activities, direct and indirect, and see our role much more as an impactor by helping companies and businesses transition into the new economy and actually contribute to accelerating that rather than just deselecting and turning our backs.
But what are some of the complications or some of the benefits of this specific ratio?
I think transparency might be more important than a green ratio. There's a lot of considerations going into the green ratio. And I think one of the risks and concerns of this whole trend where we're moving extremely fast is that this to a too big a degree becomes a tick the box exercise. That is not where we will find the solutions. We need to actually put our minds to it. So we need to measure. So in that sense, a green ratio is helpful, but we also need to look beyond that. There's a huge amount of businesses that needs to transition, and there are new business models and new infrastructure that needs to be built, and it must be more than a tick-off exercise, and that could be a pitfall a little bit if you focus too much on single ratios.
Krishna, thank you so much for joining us, the DNB Chief Executive there. Now, U.S. equities, futures, and European stocks are trading higher, supported by some blockbuster U.S. tech earnings. Now, President Biden's ambitious spending plans were also welcome news for the market. After a spectacular run for global stocks following last March's crash, selling in May could once again be a popular trade this year. Well, Jim O'Neill, Chatham House Chair and the British economist who coined the term BRICS, said that he might get behind the strategy. He joins us now. Jim, always great to speak to you. I know you want to talk about football. We need to talk about markets, the economy, lockdown, and I guess anything in between. What do you see in the markets right now?
I'm not sure I do want to talk about football.
You know you do. We all know you do, Jim. But let's start with the markets. Is it looking a bit frothy given the kind of constant earnings beat that we saw, especially from big technology companies?
I think it's definitely trickier. It seems to me from the tiny bit I've read that the reassurance message from the Fed last night was pretty powerful. I think the absolute key to watch is the ongoing evidence about inflation and inflation expectations. What is rather encouraging in the past fortnight or so is the bond market seems to have entered a state of being a bit more chilled out about these risks. And the Fed has sort of embraced that with its kind words last night. But a lot is going to depend on ironically, as is often the case with markets, on the state of the data. Because, I mean, it looks to me, it's kind of madness really, but it looks to me as though we are going to see some most staggeringly strong data from all over the world in coming weeks. And there will be days where that really freaks the markets out, because even though it's good news, because they think it'll freak out the policymakers to abandon their monetary generosity earlier. And we're probably going to go through this ding-dong for quite a while. But at the end of the day, I'm going way back now. You tell me whether it's still even published. But I used to swear by the 5-year Michigan inflation expectations survey, partly because I knew Alan Greenspan and Janet Yellen did, but and before then Paul Volcker. But I think some things like that are still pretty stable, and that now becomes really important. Because if we saw signs that those kind of measures of inflation expectations were rising, then I think a sell in May and go away would probably be not crazy. We've come a long way, as you said in the intro.
We have. Jim, when you look at some of the, the forces at play, so what makes you worried about is there anything that makes you worried about the U.S. recovery right now?
I mean, not per se. All the issues I have and about the U.S. and globally are more to do with the sustainability and what I'd call the sort of broader environment of how business still thinks, as related to what you jokingly touched on, and we may get into, and we discussed when I was on recently, that whole nonsense of the European trash league, as I'll now call it, is indicative of a lot of business people being completely out of touch. And so policymakers are increasingly rightly focusing on trying to change the allocation of reward away from just the profit owners and manipulators to more of the wage earners, which obviously carries all sorts of challenges and risks that we haven't seen for a long time. But when you see business deliberately announcing the sort of thing that the football crowd did last weekend, it's just going to induce that kind of policy reaction way beyond football, because here in the UK, you have a government completely committed to so-called levelling up, and you see the most outrageous steps being undertaken by business in the opposite way. And so part of the question depends on whether business is really getting it and trying to pursue what you and I have discussed before, the sort of profit with a purpose kind of concept, and not just be so narrow-minded and utterly obsessed with some kind of revenue maximization the day after tomorrow.
But Jim, if you look at industries, there are industries where they're, that actually they are obsessed and have a huge implication also for society. I don't know whether you see taxes rising across the world for big corporations. I don't know whether you see some of the big tech being broken up to maybe again level the playing field. Like what are the big shifts that you're seeing in corporates?
I mean, it partly depends on their lateral thinking and wisdom. I mean, again, following the football mess, I participated in a quite brief House of Lords debate on it, and there were two of my fellow peers that had the windfall tax on those companies. I wouldn't be surprised if you get more and more calls as we've seen, for a windfall tax on some of the big financial winners in terms of their stock market performance and sales, and ultimately the generosity through this pandemic. And the more you see companies inviting attention on themselves by not doing the right thing, you know, the more it's likely that policymakers will be pressurized by society to consider those things. And so, you know, more business people have got to wake up and realize that they have a societal remit for delivering more shared economic growth.
Do you think that UK companies, UK big corporations understand it more than US? And do you think that Boris Johnson will do something about it? I know he's also distracted with the cash for curtain scandal right now, but will they crack down or not?
It's tough. I mean, obviously, you know, the Tory, Boris is sort of almost become Prime Minister de facto with a sort of very splintered Conservative Party that is essentially just very good at winning elections. And the sort of general philosophy of the Conservative Party wouldn't dream of trying to be on the front foot of the kind of thing I'm talking about, because it's alien to its sort of historical roots. But there are people around that cabinet table, Michael Gove in particular, I think of, who've occasionally made speeches about capitalism having to work better so that there isn't so many people feeling left behind. And what we certainly cannot afford is some massive economic recovery coming out of this staggering pandemic that essentially widens the economic spoils even further, because that would have major adverse long-term consequences for how the whole of capitalism has been allowed to evolve during our lifetimes. So policymakers have got to do some things here to try and make sure the spoils are going to be more evenly shared. And that has to I would hope, be more voluntarily led by industry. In that regard, I mean, you ask about taxes going up. They already are. The whole move to reverse this race to the bottom of corporate tax rates, I think, is very sensible. As I tried to argue with people when I was back in government 5 years ago, the whole sort of textbook theory, if you cut corporate taxes, it boosts investment, hasn't actually worked for the past 20 years. But policymakers carried on doing it because they believe the theory. And so tightening up on corporate taxes, which can raise quite a bit of money, it is definitely a sensible thing to do. But they may have to consider more, pending how evidence and human behaviors move in coming weeks and months.
Jim, are we underestimating actually what kind of recovery we'll get? I don't know whether it's stronger, or if you see at some emerging markets and you worry that, you know, some of these variants could actually come back, that vaccines don't work. Are you optimistic that we're on the right track and that we'll put the pandemic behind us, or will it linger for quarters to come?
So, Francine, I mean, variants aside, I mean, if I look at the proprietary indicators that I presided over Goldman calculating back in the early noughties, around the same time as the BRICS thing, particularly the components for its high-frequency leading indicator, I still follow 5 or 6 of those religiously every week and month, even though I'm not in the business. And I've never, right now, the 6 that I trust the most are all showing the same thing, and I've never seen anything quite like it. And it looks to me that the next 2 quarters, many parts of the world are going to show that probably the highest year-on-year, that's easy because of the base year, but also perhaps the highest quarter-on-quarter GDP improvement that's ever been recorded. Some places, obviously India right now, won't be able to share in that, but the ongoing, in additional, more powerful, decent news, it looks to me as though there's more and more vaccines being produced. And as we creep through time, some of the manufacturing challenges are also starting to be beaten. So I suspect in the second half of the year, we're going to have a lot more vaccines that will make it easier to get a lot of these vaccines into the emerging world as well.
Jim, since I spoke to you last, I mean, there's now, we're talking about valuations of a lot of these super clubs, on the back of the league. Do you have any idea of how much Man U is worth, or do you know of anything that, that could actually change, I guess, the way that these clubs are held?
Well, if you look, I mean, it's not really a fair, normal, truly free floating price, but Man United is quoted on the New York Exchange every day, and I think where it closed last night, it was worth just under £2 billion, which is probably a lot more sensible than the ridiculous numbers that some of the red tops have been talking about. Given what's happened, in my view, these top clubs have shot their own toes. The kind of valuations that they would be hoping for if they ever had any idea of selling them has just been undermined by this self-inflicted mistake. So
do you think some of them will be up for sale?
Listen, Alex Ferguson once said to me that a football club is worth what some idiot wants to pay for it, and to some extent there's some truth with that. But it seems to me there's a lot of things now being opened by this, and the threat of regulation in the UK, which seems to me to be pretty genuine, would mean suggests to me that all sorts of things could unfold in coming weeks, even though the current owners of these clubs probably don't even realise it still.
Jim, thank you so much. I always love speaking to you about football because you're always so passionate and never mince your words. Jim O'Neill, Chatham House chair, joining us. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons joins me out of New York. We'll have a full lineup, of course, of markets. We'll look at the Fed. We'll look at a lot of the earnings out there. Today, it's Amazon, so we'll look at the everything store after that pretty impressive blockbuster beat from Apple yesterday. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America. BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Wall Street didn't build this country. The middle class built the country. And unions built the middle class.
Our nation is starving for more than empty platitudes. We need policies and progress that brings us closer together.
We've got a long ways to go, and also, it's going to be a different economy.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Good morning from London, Berlin, and New York. Our top stories today. Biden's big bet: the president tries to sell America on sweeping change while calling on business and the wealthy to pick up the tab. Shifting into high gear, U.S. futures rise, tech giants post to blowout earnings, and the Fed upgrades its view of the economy. And feeling the pinch, Apple, BMW, and Ford are now seeing their revenue squeezed as a global chip shortage gets worse. There's quite a lot going on in the markets. Of course, this double whammy of looking at the Fed that was pretty supportive of assets and looking at these blockbuster, very robust earnings. Kaylee, how's it shaping out today?
Well, and we have to look at Biden's economic spending plans that he outlined in that address to Congress yesterday. So a lot for markets to digest, and where it leaves us is mostly in positive territory for equities all across the world. It was a positive session in Asia overnight. Japanese markets were closed for a holiday, but we were up by 0.9% in China, the better part of 1% in Hong Kong. And South Korean equities actually were the only real underperformer in the Asian session. One stock in particular within the South Korean session I wanted to note was Samsung Electronics. They beat in the first quarter, but the company warned about the continued fallout of that global semiconductor shortage, and as a result, the shares closed lower by about 0.5%. The yen is the big underperformer in the G10 space today. Not a lot of bid for a safe haven asset like that. It is just shy of 109 at this point. And I wanted to point to China steel futures. They hit a record amid China's crackdown on emissions for some of the steel makers. As for what the picture looks like in Europe, it is really green across the screen on Map Markets Go, with few exceptions. You have the FTSE 100 in the UK higher by about 0.7%, even though the British pound is the outperformer in the G10 space today. It's sitting around 139.42 to the dollar. The stock 600 is higher by about 0.4%. And then in the commodity complex on the London Metals Exchange, I am watching copper. I am on $10,000 watch. I'm not sure if we'll hit it today, but right now copper futures at $9,956 a ton. As for what the picture looks like here in the U.S., it does look like it will be a positive open come the opening bell in about 4.5 hours' time. What's leading the way is technology. NASDAQ futures up a full 1 percentage point after some of those blockbuster earnings from the likes of Alphabet and Facebook last night. Of course, as Francine alluded to, Jerome Powell reiterating his dovish message yesterday, but even though yields fell on that yesterday, we are back up 4 basis points today, sitting just shy of 1.65%. On the 10-year, the dollar is mostly stronger today, recovering from its earlier weakness, but a stronger dollar not weighing on crude. WTI sitting above $64 a barrel, Matt.
You know, Map Markets Go seems like so much to type, Kaylee. You know, Map Space Markets Go. You could just type WMGO. It's short for World Markets, WMGO. It takes you to the same place, and it would be just so much easier on your fingers, I think, so you can get the same picture of global markets with that. I want to take a look ahead to what's coming up today at 8 a.m. New York time. We're going to get the latest read on Germany's inflation data. At 8:30, we're going to get U.S. GDP. It's forecast to show 6% growth in the first quarter. Pretty big deal for the United States of America. Finally, it's another big day for tech earnings. Pretty big day. Amazon as well as Twitter, will report after the market closed today. And Amazon, Francine, has to be one of the biggest beneficiaries of the pandemic because I don't know about you, but we get pretty much everything online. And Amazon, of course, has a huge share of that market.
Yeah, I kept on joking for like, a long time that it makes me a better mother just because I pre-buy presents for any kind of occasion. And that's certainly true in the pandemic.
Exactly.
I was looking into some of the funny stuff. Matt, I think they're now talking about Amazon hairdressers, which I don't know. I need to dig deeper into it, and then we'll have a discussion with you and Kaylee about it. Now, President Joe Biden made his debut speech to Congress yesterday after almost 100 days in the job. Well, he laid out the goals for his $1.8 trillion stimulus plan, as well as how he was going to pay for them. Senator Tim Scott delivered the Republican response.
Tonight, I come to talk about crisis and opportunity. Together, we passed the American Rescue Plan, one of the most consequential rescue packages in American history. We're going to get rid of the loopholes, allow Americans to make more than $1 million a year and pay a lower tax rate. And the IRS is going to crack down on millionaires and billionaires who cheat on their taxes. Trickle-down economics has never worked. And it's time to grow the economy from the bottom and the middle out. Wall Street didn't build this country. The middle class built the country. And unions built the middle class. There is simply no reason why the blades for wind turbines can't be built in Pittsburgh instead of Beijing. No reason. None.
Our nation is starving for more than empty platitudes. We need policies and progress that brings us closer together. But 3 months in, the actions of the president and his party are pulling us further and further apart.
Well, let's get straight to our Bloomberg editor-at-large, Marty Schenker, who joins us now. Marty, this was a speech on unity, a speech on America coming together. Will it work to unify, the troops and the citizens after a pretty testy 4 years?
Yeah, I think the word normal comes to mind. It was remarkable how different the tone and structure of the speech was, reading from the prompter as Joe Biden does, and ad-libbing at certain points, but it is an attempt to bring the population watching together rather than the people in the audience, especially the GOP.
Yeah, I mean, Tim Scott pointed out that in terms of unity, Biden hasn't made any strides, on Capitol Hill. But the striking thing, Marty, is that the majority of people in America across the aisle, although there's no American aisle, but you know what I mean, support President Biden's policies. Isn't this discrepancy fascinating that, a lot of Republican voters support Biden's policies, even if they don't like him and even if the senators won't vote for them? Yeah,
it's the dichotomy of the public versus the politicians, right? And I do think that what Biden gets is a lot of high marks for his handling of the pandemic, less so for taxes and spending. And if you look at the public polls, they do want Republicans and Democrats to come together and compromise. And they did on the initial rescue plan, but there's no sign of that going forward from here.
Yeah, now comes the hard part. Thank you so much to Bloomberg editor-at-large Marty Schenker for joining us. Now let's turn to big tech earnings. Apple and Facebook reported after the close on Wall Street, and the pandemic demand surge continued for both companies. Facebook sales and users jumped. Apple crushed Wall Street expectations, fueled by sales of the 5G iPhone as well as iPads and Macs. Let's get more now with Bloomberg's Danny Berger. Danny, it was a blowout for both of these big tech companies.
It really was. And Kaylee, it's pretty interesting because the trend, or at least the common thread that allowed these earnings to be so good, was similar between the two of them. And that is that pandemic habits are still among us. For Apple, that means people are still working at home. They're still learning at home. So they're making purchases of iMacs and iPads to help them do that. Those sales nearly doubling. Now, they did warn about the chip shortage, but that wasn't enough to take the wind out of the sales. Shares up 3% pre-market. It also doesn't hurt that they announced announced another $90 billion buyback, so buybacks alive and well. When it comes to Facebook, people aren't out. They're still in. They're still scrolling through Instagram, looking for their phones for at-home entertainment. So with more online user growth, those active daily users growing 10%, it meant ad prices could also jump by 30%. So those shares moving higher. Twitter also moving higher pre-market, just with this anticipation that the online ad environment is really strong.
Danny, thanks so much. Our Danny Berger there with some of the big tech reporting with pretty robust earnings. That's probably a euphemism. Kaylee, what else are you watching in the markets?
Well, as Danny mentioned, Francine, Apple does have to contend with that semiconductor shortage. It could knock $3 to $4 billion off their fiscal third quarter, and there are a number of other companies contending with that as well. One of them being Ford, which reported after the bell yesterday. It had to cut its outlook, said it could take a $2.5 billion cost because of that semiconductor shortage. Those shares are down 2.7% in pre-market trading as a result. But speaking of chips, Qualcomm is moving higher. It had actually raised its outlook for the current period due to the strong demand for 5G iPhones. It's up about 5.3%, but to the downside, eBay missed expectations when it came to the current quarter forecast. The company warning it may not be able to fully hang on to the gains from the pandemic as the economy reopens and the boost from the stimulus checks fade. That stock is down the better part of 6%. ServiceNow, an IT software company, is down more than 6% after its outlook missed also, Francine.
Yeah, so much to talk about today. I mean, so many earnings. We're really in the full swing of things. Now, coming up, STMicro's sales of $3 billion beat estimates. We'll be speaking to the chief executive, Jean-Marc Chéry, shortly. After that, Neil Sherring, Capital Economics Group chief economist. We'll talk to him about the Fed. We'll talk to him about inflation and the price of lumber. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kaylee Lines in New York. Now, I was blown away yesterday when Ford put out its earnings and then said that 50% of their second quarter production is going to fall away because of the chip shortage. It's going to cost $2.5 billion, but just the idea that they won't be able to make half of the cars and trucks they wanted to make this quarter It hurts my soul. I found this chart. Hillary put it together for me. This is chip prices. They're for mobile devices and PCs. We're talking DRAM here. So these are not the same chips that Jim Farley is having trouble sourcing, but they tell a story that I think is still interesting. You see that prices have come down since 2019 and have now shot up. That makes sense, Francine. In a chip shortage, prices are getting higher, but they still haven't reached the heights of pre-pandemic 2019. So I wonder if there's still room to rise when it comes to certainly DRAM prices, but for a lot of different chips out there that are just hard to get.
Yeah, and so many people are actually asking how long does this also last? So the global chip shortage has translated into strong demand for semiconductor makers like STMicroelectronics. The French-Italian company beat earnings estimates and will increase its capex spending this year. It's a key provider, of course, of chips to the autos industry, for example, which is being hard hit by supply constraints. And we're delighted to be joined by Jean-Marc Chéry. He is the chief executive of STMicroelectronics. Mr. Chéry, thank you for joining us. First of all, the million-dollar question is how long do these chip shortages last? How many quarters will this continue to happen?
We do believe it will continue for at least for the next 6 months, but most likely for the full year. But simply for the reason that the process equipment lead time now are well above 9 months. So in any case, if you want to increase your capacity now, it will not be for Q1 or Q2 2022. So the short, what we classify the shortage, be what I classify a gap with unprecedented demand versus what we install, okay, will last up to the end of the year minimum.
And what are your clients, what are the industries most affected? So I know you've spoken quite a lot about, you know, what will drive the rebound and the fact that car makers at the moment are so affected by this. Who else?
Today we have all the verticals, okay, clearly requesting a semiconductor. The acceleration of Q4 and Q1 is more related to the automotive industry, but the industrial verticals as well. And on industrial, it is high-end, but consumer industrial. So home appliance, power tools. Okay, so everybody are asking, okay, semiconductor driving by the power energy efficiency, by the electrification, the digitalization. So all the verticals are impacted now.
What can you do, Jean-Marc, to boost chip production? And how big a bet should you be taking right now as, you know, this bottleneck could open up?
What we have done, with the visibility we had a few months ago, our capex model was 1.5, 1.6 billion, and we prepare ourselves to make $11 billion. Now we boost our capex to about $2 billion, maybe slightly above. And we will deliver $12 billion of revenue, 18% growth. But believe me, for the industrial market and automotive, our growth will be between 30 to 40%. 30 to 40% growth for industrial and automotive.
We just heard last night President Biden argue that there's no reason you can't produce, I think it was turbines or some sort of manufactured product in Pittsburgh rather than Beijing. What about chips? Is it easier to produce them in Asia than, say, here in Europe or in the United States?
Absolutely not. And ST is a perfect example. In Europe, we have 5 wafer fabs, and we are building another one, a big 300 millimeter fab. So we will have a 6 wafer fab, okay, by the end of the year. And you can produce, okay, very easily in Europe or in US.
You had some pretty significant margin expansion in this quarter. Gross profit margins increased 110 basis points year on year, operating margins by 420 basis points. What is driving that margin expansion, and can it continue?
This is mainly the manufacturing efficiency. Because when you run our wafer fab at 100% of capacity saturation, our efficiency is huge. And in a certain extent, the product mix. Because when we grew, okay, Q1 versus Q4, okay, there is a slightly decrease sequentially. But when you look inside the verticals, there is a strong growth on the automotive and industrial market versus the personal electronics. So that's the reason why also the product mix play a bit in our margin. But main contributor, manufacturing efficiency.
But Mr. Shea, have you not had any discussions with politicians that say, even if it's more expensive, you should produce more in Europe? I mean, it's actually sometimes crazy to think that we can't produce more of these things because we're so dependent on certain other countries.
It's not a question to be more expensive and so on, because again, it's more complex than that. Okay, it is related to your strategy. It is related where you have people skill and competencies. Okay, it's not a question of labor cost or cost. Okay, we are in Europe. We are in strong install base in Europe, and we are competitive. And ST, okay, is in the market we address. We are in the top 5. So you can produce, okay, in a competitive way anywhere in the world. More important is the infrastructure you have, the skilled people you have, the determination you have.
All right, thank you so much. Jean-Marc Chéry there, the Chief Executive of STMicroelectronics. Now, coming up on Bloomberg Technology, we'll also continue the conversation on the chip shortage with Qualcomm Chief Executive Cristiano Amon. That's at 5 p.m. in New York, 10 p.m. in London, and this is Bloomberg.
Good morning, traders. Hope you're okay, and right straight to the business. I'm going to place an order to sell short euro. The price I'm looking to sell 121.20. Okay, order placed. You still have time if you want to sell short euro. If you want to trade euro, here is your chance. Okay, order placed, and I'll speak to you later after it will get filled. Okay, stay safe.
Within reach. The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get straight to the Bloomberg First Word News, and President Biden is betting he can sell the American public on sweeping changes. Last night, in a speech before Congress, the president called for higher taxes on the wealthy to fund a massive investment in the nation's social security net. He's asking for trillions of dollars for infrastructure, childcare, education, and subsidies for working-class families. Well, politics may force the president to eventually abandon some of the more ambitious ideas. Legal experts say federal authorities may be on the verge of bringing charges against former Trump White House lawyer Rudy Giuliani. FBI agents raided Giuliani's Manhattan home and office. There's been a long-running investigation into his work in Ukraine, including attempts to dig up dirt on Joe Biden, while Giuliani's lawyer denied any wrongdoing. HSBC is offering its ultra-rich clients in Asia direct access to its investment bankers. The London-based bank is trying to become a wealth management leader in an increasingly affluent region, while HSBC, we understand, will offer the wealthy a full slate of finance and investment products, deal-making, and institutional market access. And finally, the Italian island of Ischia has a plan to save its economy from another disastrous tourism season. Residents are waiting for a boatload of vaccines that will create herd immunity among the 70,000 inhabitants. Now then, they'll declare Ischia a COVID-free zone and wait for an influx of visitors from Europe and the U.S. But on mainland Italy, regional governors argue that no one should get priority treatment. I know we've been talking a lot behind the scenes, Matt and Kaylee, about, of course, holidays, whether people can travel or not, the vaccines, but it does seem much easier if you're an island state, or just an island like Mykonos in Greece, or Ischia, even Capri in Italy, if you can be almost self-sufficient, vaccinate everyone, and then tourists, tell tourists to come because it makes up like 50 or 60% of their GDP.
I know, well, Kaylee wants to travel to an island, but it's not off the Italian coast.
It's not.
It's a lot bigger, and they speak English. But Ischia looks gorgeous when you Google it. And you can rent a mini moke there to drive around. It's one of the coolest little buggies you can rent, a mini moke.
I know, now I'm questioning my decision about Ireland. I did, by the way, actually book my flights. I'm confident I'm going to be able to go this summer, but maybe I should have picked a different island instead, one with maybe a beach or something. Honestly, though, any vacation at this point sounds great.
Yes.
I'll take anything.
Yes.
Kaylee, I told you, just make sure the weather is good in Ireland. So, you were warned before of it.
I was.
It is actually a serious economic problem for, Italy, Spain, Greece, that are so reliant on tourism. So they haven't vaccinated, or they haven't reached critical vaccination yet. And so you have to try and figure out how you get tourists out, but keeping everyone safe. Coming up, we look at the Fed upgrading the view on the economy.
As you can see, we have to cancel order to sell short because it moved down, so we didn't have a chance to enter this position. Let's see other forex pairs, and let's wait for other good opportunity to trade euro. Okay, so please do cancel your order to sell short because it's already moved down. Stay safe.
By that, these are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? and you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, early edition. I'm Francine Lack in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Matt, if you look at the markets, they're on a roar. They're on a tear for two reasons. Of course, it's all about the Fed and the fact that they're pretty confident about, pretty confident. Again, I keep on using these euphemisms. They're very confident about the economy, but they're not talking about tapering. And these blowout earnings from the tech companies in the U.S.
Yeah, no, absolutely. I mean, the earnings have been stellar, although that hasn't helped every company that doesn't put out a stellar outlook accompanying the earnings release. But really, it's all about free money, Francine. As long as the government keeps handing out free money and the Fed continues to finance it, why wouldn't the markets rally?
Absolutely. I guess we'll know more about what the economy is doing, with CPI, but also GDP on Friday. How's it playing out in the markets, Kaylee?
It's risk on, Francine. Both sides of the Atlantic, you see stocks in the green. You have that dovish Fed, you have robust earnings, and then, of course, you have the prospect of more stimulus potentially coming here in the U.S. after Biden outlined his long-term economic spending plan yesterday. So where that leaves us is up 0.4% on the stock 600 here in the U.S. Come the opening bell in about 4 hours' time, it does look like we will be solidly in the green, especially on the NASDAQ 100 futures, up nearly a full percentage point on some of those big tech earnings. I'll have more on that in just a second. But on that dovish Fed, we did see yields come down yesterday as Powell reiterated his message that they aren't changing anything anytime soon. But once again today, we're seeing yields move back up 4 basis points on the 10-year. We're just above 1.65%. And guys, we are getting closer and closer to 10,000 when it comes to copper futures on the London Metal Exchange. Right now, we're sitting at 9,975. I will be watching every single tick on that futures chart all day today. Now, as for some individual stocks I'm watching, come the opening bell, Facebook, of course, is one of the companies that reported blowout earnings after the bell. Revenue growth 48%. That blew past analyst expectations. It's all about that digital advertising boom, the same kind of phenomenon we saw benefiting Alphabet yesterday. Apple is also higher by the better part of 3%. Really solid iPhone 12 sales, Macs, iPads, you name it. But the company did warn about that semiconductor shortage. That could mean a hit of $3 to $4 billion in the fiscal third quarter. One of those smartphone chip makers is Qualcomm. It had a really bullish second quarter outlook, and those shares are up the better part of 5%, but we know that chip shortage is weighing on automakers, and Ford yesterday cut its outlook. That could cost the company $2.5 billion. So those shares are down 2.4%, and it's like I can feel you frowning, Matt Miller.
No, not at all. I thought the Ford story was fascinating. It doesn't bum me out until I start thinking, I hope they don't reduce F-150 production. But I don't think they will, because they're going to focus on the products that have the highest margins. So it's going to be the cars that I don't really care about that they're not going to make as much of. By the way, I was looking at that copper price as well, Kaylee. We got to get hats. We got to get copper 10,000
I love
hats. I have a chart for Francine that shows, because you're talking about GDP and focused on the amazing growth that we've seen, it's a bit of a spaghetti chart. But basically, this is 5 years in terms of EPS revisions. So it shows earnings performance or expected earnings performance from analysts. The only line you need to look at is the white line. And for those listening on radio, the white line is the one on top that goes through and then exceeds all of the other lines. So earnings revisions for 2021 outpaced all earnings revisions for the last 5 years. I think that says a lot about economic growth, Francine, or expectations for economic growth.
Yeah, it does say a lot. Transitory was also the word yesterday. The Fed upgraded its view of the economy, signaling that risks from the pandemic have diminished. Now, it kept rates near zero as expected and attributed inflation pickup to transitory factors.
While the recovery has progressed more quickly than generally expected, it remains uneven and far from complete. Continued vaccinations should allow for a return to more normal economic conditions later this year. We are also likely to see upward pressure on prices from the rebound in spending as the economy continues to reopen. However, these one-time increases in prices are likely to have only transitory effects on inflation. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. The economy is a long way from our goals, and it is likely to take some time for substantial further progress to be achieved. We've got a long ways to go, and also, it's going to be a different economy. The only thing that will guide us are the tests met? You know, that's what we focused on, is have the macroeconomic conditions that we've articulated, have they been realized? That will be the test for tapering asset purchases and for raising interest rates.
Well, joining us now is Neil Shearing, Group Chief Economist at Capital Economics. Neil, a lot of data that we have to get through today and tomorrow in the U.S., but what's very clear is when you hear actually the Joe Biden ultra-expansionary thrust, it seems that instead of trying to taper that or temper that, the Fed is really amplifying them. What does it mean for the U.S. economy going forward?
Well, it's a good question. I think that's exactly right. What the Fed is doing, essentially the message from the Fed last night was, we're not planning to do anything right now. We're going to accommodate all of this. And we're really waiting to see just how quickly the economy does bounce back. I think policymakers, both in government and in the central bank, have kind of learned the lessons from 2008 and are going to stay the course this time, which I think is probably the right thing to do. What it means for the economy is we're going to see some incredibly rapid rates of economic growth, I think, in the US over the coming quarters. I suspect that by the early in Q2, probably around now actually, in the recorded data, the economy is going to be close to its pre-pandemic levels, and it will blow quite quickly through that and get quite close to its pre-pandemic trends, I suspect, by the start of next year.
Neil, Kaylee reminded me, of course, GDPs today. Tomorrow, for example, we have the University of Michigan 5-year inflation forecast, which is something that Jim O'Neill is looking at. What are the chances of this economy overheating without the markets realizing straight away?
I think it's actually as I look across the globe, I think in general, inflation pressures at this stage and kind of inflation risk are probably slightly overdone. That's certainly true in Europe. We're going to see this kind of mechanical rise in inflation in Europe over the coming months and quarters, but it's really about energy and prices of some goods that were depressed in the pandemic rebounding. The US is in a completely different situation, and the reason it's in a completely different situation is the scale of what's happening on the fiscal side of the ledger. Just so much stimulus has been pumped into this economy that I think there is a substantial chance, actually, that these are not transitory inflation pressures in the US, and that we do start to see some meaningful build-up in price pressures, both on the consumer side. Obviously, we're already seeing that on the asset price side.
Can't we handle that? I mean, we could handle 2-3% inflation for sure, Neil. What kind of levels are you thinking we'll see?
Well, I think 2 or 3%, I suspect we probably will see. Yes, I suspect we'll get there at some point over the next kind of 12 or 18 months or so. The question that I don't think anyone can really answer, including those on the FOMC, is once we get there, what happens? Once the inflation genie starts to kind of creep out the bottle, can you get the lid back on? Or does the whole thing really then take off and we get to kind of 4, 5, 6, 7%? No, I don't think that's going to happen, to be clear. I think comparisons with the 1970s, which is what everyone tends to reach for, I think are also slightly overdone because institutions are very different. Labour markets operate differently. The global economy and the role of technology and globalization is very, very different too. Labour's bargaining power is very different. So I think I wouldn't look back to 1970.
Okay, guys, I'm looking to sell short British pound. If you're up to trade in British pound, the price I'm looking to sell 139.55.7. Okay. Okay, I place an order at 139.557. So stay with me. If you want to trade British pound, place an order. You still have time, and I'll let you know when we will get filled, what's going to happen next, how we're going to trade this pair. Okay? I'll speak to you later, guys. Stay safe.
To ask for a coronavirus vaccine, they told me it's a 2-doctor operation. They had 2,000 people on the waiting list, and last week they received 18 doses of the vaccine to pass around. So clearly we're very far behind here. What kind of bifurcation is that going to create in terms of the economic recovery between Europe and the U.S.?
I suspect it probably doesn't change where Europe ultimately gets to. I think, unlike in 2008, where the US and Europe had much slower, entered the period of much slower growth after the crisis, I suspect, and ultimately settled on a lower trend, I suspect this time probably is different, and that all economies on both sides of the Atlantic get back to their pre-pandemic trends. What's going to happen, though, is it's going to take Europe and in particular countries in the Eurozone a lot longer to get back to its pre-pandemic trends. I suspect it's going to take several years. In the US, I think we're going to get there much quicker. So it's a case of Europe's recovery being delayed rather than cancelled altogether.
Right, and there's the fiscal factor involved in that Europe's fiscal spending has been a lot less robust than what, as you mentioned, we've seen here in the U.S. So I want to get your take on the long-term economic spending plan that President Biden outlined in his address to Congress last night. What is your base case about how much money we could actually see, and then what the growth impact of that would be?
Well, I think this now has to go through the kind of congressional process. We know it's going to get cut up and dissected, and bits will get traded off, and there'll be and what will ultimately get passed will look very different to what was proposed last night, I suspect. So I suspect the ultimate package might be a bit smaller. But I think the really important point to make is that this package, and indeed the package on infrastructure, was very different from the round of stimulus checks that we saw. That was stimulus. That was debt finance stimulus that was being pumped into the economy, whereas this is tax financed spending. So in terms of the stimulus to demand in the economy, it's going to be much smaller. So we've got $1.8 trillion of spending financed by $1.5 trillion worth of tax increases. And when you spread that out over the time period that this is going to take place, many years, is not going to amount to, I don't think, it's not really going to move the needle in terms of economic growth. I think it will make a major difference in terms of kind of have implications for sectors, and on the infrastructure side, it'll make a big difference to potentially the capital stock of the US economy. But in the short term, day to day, quarter to quarter, the impact on demand and growth, I think, is going to be a lot smaller than the big rounds of stimulus checks that we saw earlier.
Neil, thanks so much. Neil Sharing there, Group Chief Economist at Capital Economics. Now, coming up, U.S. futures on the rise after blowout earnings. Our roundup of the results next. We'll also talk about Wimbledon, actually. I think tickets have started to go on sale at 25% capacity. This is Bloomberg.
mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
We've had strong underlying sales growth of 5.7%. That means we're growing faster than our markets, and it's thanks to our focus on running our business with operational excellence, some good innovation, our purpose-led brands doing well.
So yes, I think we've had a good start to the year. We, as you say, had a significant increase in profitability, up 18%. The 1.4 billion is one of the biggest quarters profit-wise we've had for several years.
I think we should not take Q1 as an indication of the full year yet. There's still a lot of volatility, of uncertainty. I think we have not passed what we call the tipping point of the pandemic, and therefore we have to remain quite prudent. We see a lot of diversity in situations across the globe on the recovery or sometimes the aggravation of the pandemic. It was rightly mentioned, and India is really in a very difficult place. So it's a good Q1, but it's not yet a full year.
Unilever Chief Executive Alan Jope, Standard Chartered CFO Andy Halford, Airbus Chief Executive Guillaume Faury, just some of the chief executives talking to us on earnings earlier on Bloomberg. Now, stocks getting a boost today from tech earnings and the Fed. Laura Cooper, Bloomberg MLive macro strategist, joins us. Laura, talk to us about earnings. I feel like most company actually I look at are actually delivering some pretty blowout earnings. Is there a danger that we get lulled into a false sense of security and then next quarter will be too tough to beat expectations?
Well, I certainly do think that that's the case, because we have really seen just this stellar earnings season so far. Just looking at the stock 600, earnings surprises have come in by about 40%, and that's largely driven by financials. And then we have those tech blowouts yesterday coming through in the U.S. But what I think price action is telling us is that, yes, we do have this near-term boost, but more broadly, sentiment is quite stretched, positioning is quite bullish, and I do think a lot of good news is priced in. So like you mentioned, the risk now is that we already knew that healthy earnings were needed for equities to grind higher, but what will be that catalyst to push them even further? Because largely the indexes have been fairly range-bound over the past couple of weeks.
What about a dropping dollar? I mean, does that help in terms of more foreign direct investment? So more foreign investors, coming into the equity market?
I certainly think that is what the dollar will potentially do, is just continue to support that rotation trade that has stalled over the past month or so. But really, we're going to see those flows back into those cyclical sectors, back into those value stocks with Europe, because Europe is still, that catch-up story still remains. Notably, when we look at European banks, the fact that they have had just these really strong earnings, overlaid with the fact that valuations continue to be quite deeply discounted, I would expect that the dollar weaker will feed into that clear trade.
Laura, I want to ask you about margins, specifically input cost. I am literally watching my chart to see if copper hits 10,000 today, and we've heard a lot about higher commodity costs and the pricing pressures that have resulted from a lot of consumer goods companies. But then, of course, there are other supply issues. We've seen it with Ford, Apple, Samsung, the semiconductor shortage. Are supply shortages an underappreciated risk in this market, or do you think that's properly?
Okay, guys, position opened on British pound, as you can see, at 139.557. That's a short position. You still have time and chance to open because price moved up. For all of you guys who placed an order and open position, stay with me. We will go through this trade, and I will guide you what we're going to do when we're going to place stop on profit and when we're going to sell it. For other people who want to get strategy, who is wondering what is going on, how can I start trading, you need to buy strategy. We do not give it for free. The strategy you can be purchased on our website, companyeye.co.uk. So go to our website and get the strategy. Then you can see our live day trading sessions. These sessions are free, so you don't have to pay anything at all. You can practice the strategy, and you can get your second job, or you can get your primary job as a day trader. You can work for banks or hedge funds because you will have your own strategy, and you will make money not only for yourself, you can make money for other people. I'll speak to you later. Well done, and stay with me.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
So, you know, I'm very bullish on India. In fact, in our fund, the largest allocation is India. And I'm frankly surprised that despite this terrible news about the COVID secondary outbreak, our stocks in that market are doing quite well. Now, there's no guarantee, you know, whenever you have this kind of bad news, it will affect the psychology of the market, and you might see some decline. But generally speaking, India is on a run. And despite this problem, and I think, of course, it will be temporary, more and more people will be vaccinated, and the death rate will decline. Nevertheless, there is an impact, and we can expect some correction, but not a big one.
Mark Mobius there, Mobius Capital Partners founding partner, speaking with Bloomberg earlier today on India's stocks amid its COVID crisis. Now let's talk more about earnings and also the Fed. Tom Keene, co-anchor of Bloomberg Surveillance, joins us. Tom, I know you were really focused on the word that I also picked up on, which was largely by Jay Powell yesterday.
Yeah, well, what Jay Paul said yesterday was really interesting. I mean, he got through it in one piece. I thought Mike McKee ended the press conference with a trenchant question that nobody wanted to answer. But there you go, and on we go. I believe it's to June 16th as well. Francine, we got a dovetail here going on right now, and there's a price to pay. We've got phenomenal earnings from these technology juggernauts, which are absolutely original in our business and our national history, along with the pandemic that Mr. Mobius just talked about. And you can go, well, what's it devolve down to? Let's look at the chart. This is my chart of the year of 2 of the last 4 years. This is the twin deficits. Take the fiscal deficit to GDP and the trade deficit to GDP and add them together. Francine, all you need to know is the math isn't that good. The research says they're really not linked. But the fact is right now we really care. And they are out to 4.8 standard deviations. Francine, this is truly something no one ever imagined.
Yeah, and the other thing, Tom, I know you're a great student of history, and if you look at, I guess, the Biden-Powell duo, a lot of people are saying it's a little bit like what Reagan and Volcker was, but in reverse, right? If you look at Reagan, Volcker, and the regime change there, it was really powered the economy,
Well
shifting
said.
to government from market and from labor to the owners of capital, and we could see the reverse now.
I think that's really well said, that it harkens back to the regime change of Reagan and Volcker of another time long ago. I don't even know what the British analog is. I honestly don't know what the British analog is. Maybe it's in the 19th century, but that twin deficit chart, Francine, is absolutely original, out almost 5 standard deviations.
Tom, thank you. I'm looking forward to the program. Tom Keene, their co-anchor of Bloomberg
Amazon's out with earnings.
coming up after this. I know we're all over Amazon. This is what we're watching for the rest of the day. Now, we're watching a little bit of sports and then Amazon, Kaylee.
I know I should probably be watching Amazon or the economic data at 8:30 a.m. Eastern time, but I'm actually watching what's happening at 8 p.m. Eastern time, and that is the NFL draft taking place in person in Cleveland. I might stay up past my bedtime to watch it, Matt, and watch Trevor Lawrence, the quarterback out of Clemson, go as the #1 pick to the Jacksonville Jaguars. I'm pretty excited for it.
That is so cool. I love the draft, and the Super League would have probably had a cool draft if it had ever gone forward. I am watching Hillary Clark become a grown person. It's her birthday today. She is my erstwhile charts producer, and I just wanted to wish her a happy birthday. And you hang in there, kid. We're all rooting for you.
She's like the queen of charts and the queen of hearts for all of us. She does really some of the best charts in town. I'm watching actually Amazon, so that's the big one. We'll see if they also have some blowout earnings and how much.
Okay, guys, we're going to play stop on profit for British pound at 139.537. Okay, stop on profit placed. So anything what will happen with these pair, you will not lose any money. All of you guys who decided to purchase this pair and follow this trade, well done. You're already in profit, and you will close this trade if price will change direction in profit. Okay, let me just point out for new people, for them just to understand where we purchased, where we placed stop on profit. Okay, this is a live stream, so you need to understand this is not recorded video or something. We always place our positions, our orders before it will get filled. So for all of you guys, we don't try to trick you. We just trade live. We trade live our own money at the end of the day, and it's up to you. If you want to follow our trade and make some profit by trading Forex, you can do this. If you don't want, you can just watch it and enjoy our profits. Okay, right now I'm going to move further, stop on profit to 139.507. It will give us 5 pips. In real life, it will. If we will close this trade in real time, it will give us £500 in profit, because 1 pip we trade with on margin, and it gives us £100. Okay, stay safe, and I'll speak to you later, guys.
And we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Okay, traders, I'm going to move further my stop and profit to 139.457. Okay? So please do so as well if you decided to follow my trade. And we're already 10 pips in profit, equals £1,000. So please do so and enjoy your profit and enjoy your ride, because we haven't sold yet. The price still moving in our favor, and we will see when we're going to close this position. Stay safe.
Change. We're all becoming behavioral scientists.
There are several mega trends here that will probably make this cycle hotter for the next several years.
This is not just overheating. There's a risk that this is like starting a fire. So there is a chance that inflation could be overshooting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Tim Cook knocking it out of Cupertino Park from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg Television alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive 0.6%. Tom, the numbers that Apple just put up, absolutely huge.
Well, we saw Google, then Apple yesterday, and Amazon this afternoon, John. And I think Julian Emanuel needs a massive shout out at BTIG. He absolutely nailed the importance of yesterday. John, yesterday was a reaffirmation of what we're living with as technology companies. I believe firmly we don't really understand their dominance. Jim Suva at Citigroup goes from 150 to 170, up 27% on Apple this morning.
Got an upgrade from Goldman this morning as well, Tom. Revenue up 54%, and $90 billion additional buyback into the mix as well. Could those numbers get much bigger, TK?
Well, I don't know if they can get much bigger, but they can be persistent. What's important about what Cook has wrought, and I give great credit to the late Steve Jobs, is since 2012 they have decided to deploy to share repurchase, and it's so much, John, the chronic nature of it. Every quarter there's too much cash from their profit, and they use it to assist shareholders and also to build a new campus in North Carolina.
The P word, the right word, Tom. Persistency of this growth has been absolutely unreal. Lisa, we do also need to touch on execution risk. That's been a theme of the last 24 hours.
There's been a concern about some of the chip shortages, and we saw that with Ford earnings coming out, really disappointing as a result of that. Apple being the exact opposite. And just to give you some scope here, every region revenues grew for Apple more than 35%, including a 94% gain in Asia, just to give you a sense of the acceleration here. But just to also give you a sense of perspective in terms of what markets are priced for, the Apple shares of Apple are up less than 3% in pre-market trading after being up less than 1% year to date. John, try to square that.
I couldn't agree more. Stock's not responded. We've had record geographical growth in each geographic segment. Record growth, Tom. Record revenues and double-digit growth in each product category, and yet here we are.
Well,
here we are talking about what, a stock that's hardly moving.
Go back to Valentine's Day pre-pandemic, and you'll see that the major fangs in fits and starts find a time to move. They simply don't move on the present news. They move on the expectation, and Wall Street has to reset where they are in Apple. Imagine how we're going to reset tomorrow on Amazon.
This bond market reset, can we talk about the quiet sell-off in the Treasury market?
Yes,
Let's whip through the price action. Yields higher on a 10-year. Not getting much discussion this week. We've had a move of 10 basis points on a 10-year yield on the week so far. 165.57 on 10s, up another 4 or 5 basis points on a session. Equities, get used to it maybe. 4,200 on the S&P 500. There it is in futures, up another 27, 28 points, and we advance 0.7%. I'll touch on the commodity market a little bit later in the program. A big call coming from the team at Goldman in the last couple of days. 64.56 right now. Goldman thinks maybe 80 in the next 6 months. Lisa, we got a lot to get through.
Yeah, this definitely commodity super cycle seems to be a common theme among a lot of strategists. I gotta say, there is a question that grows with respect to data. When does it matter? Today at 8:30 a.m., we get U.S. initial jobless claims. They are expected to come down somewhat significantly. The whisper number is actually under 500,000, but it's about 540,000, the consensus. Still elevated, and yet nonetheless, we're also expecting a first quarter GDP number of 6.6%. I know you don't like a quarterly GDP number, John, but there is a question here about how hot this economy can run before people recognize it as such, people being Jay Powell. Then 11 a.m., the Fed's Randy Quarles is going to be speaking at an OCC meeting talking about financial regulation. I'm very curious to hear what he says, especially after Jay Powell yesterday said that the Archegos incident showed that there were risk management problems at certain banks. I wonder how much he's going to come out and talk about regulating some of the derivatives, or at least giving a little bit more transparency around some of these trades. And after market, the earnings roll continues. Amazon and Twitter expected to report earnings. I am watching the stock price reaction. How much do they have to blow it out of the water for stock traders to care? How much is already priced in, and what exactly are they pricing in? I mean, honestly, it seems like no beat really matters, John, when it comes to the stock trading activity afterwards.
Let's talk about the reaction this morning. You touched on it briefly, Lisa. I want to talk about Apple and have a look at Ford as well. Ford is down in the pre-market. Why? There is a chip shortage. Can supply meet demand? Execution risk, the issue here. Ford down a little more than 2%. Tom, Ford putting a number on it. They've had to cut planned production in the second quarter by 50%. Apple putting a number on it. It's going to constrain revenue around the Mac and the iPad, 3 to 4 billion. Look, 3 to 4 billion off quarterly revenue for Apple is nothing in the context of the fact that they just posted a $90 billion quarter. But for Ford to slash production in the second quarter by 50%, Tom,